Investing is about making your money work for you. Instead of sitting idle, your money grows over time. It's like planting a seed that blossoms into a tree bearing financial fruit. Investing is crucial for building wealth and achieving your financial dreams. It's not just for the wealthy, it's for everyone. Whether you're saving for retirement, a down payment on a house, or your child's education, investing helps you reach your goals faster. Remember, the earlier you start, the more time your money has to grow. Investing might seem complex, but it doesn't have to be. This guide will break down the basics, empowering you to take control of your financial future. Let's embark on this exciting journey to growing your wealth. Imagine this, you have $100 today and it can buy you a cart full of groceries. Now fast forward 10 years. That same $100 might only get you half a cart. This is because of inflation, which erodes the purchasing power of your money over time. Simply saving money under your mattress isn't enough. Your money needs to grow at a rate that outpaces inflation to maintain its value. This is where investing comes in. By investing wisely, you can earn returns that outpace inflation, ensuring your money grows in real terms. Don't let inflation silently chip away at your hard-earned savings. Take charge and put your money to work. There are various investment options, each with its own risk and reward profile. Understanding these options is the first step towards making informed financial decisions. Whether you're a seasoned investor or just starting out, knowing the basics can help you navigate the complex world of investments. Let's explore some of the most common ones in detail so you can decide which might be the best fit for your financial goals and risk tolerance. Stocks. Owning stocks means owning a small piece of a company. Stocks offer the potential for high returns, but also come with higher risks. When you buy a stock, you become a shareholder and can benefit from the company's growth and profits. However, stock prices can be volatile, and there's always the risk of losing your investment if the company performs poorly. Bonds are like loans you give to governments or corporations. They offer lower returns than stocks, but are generally less risky. When you purchase a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds can be a good option for those looking for more stable and predictable returns. Mutual funds. These are baskets of stocks or bonds managed by professionals. They offer diversification and are suitable for beginners. By pooling money from many investors, mutual funds can invest in a wide variety of assets, reducing the risk associated with investing in individual stocks or bonds. This makes them an attractive option for those who prefer a hands-off approach to investing. ETFs, exchange-traded funds. Similar to mutual funds, ETFs trade on stock exchanges. They offer diversification and are highly liquid. ETFs can be bought and sold throughout the trading day at market prices, providing flexibility and ease of access. They often have lower fees compared to mutual funds, making them a cost-effective way to invest in a broad range of assets. Real estate investing in property can provide rental income and potential appreciation in value. However, it requires significant capital. Real estate investments can take various forms, including residential properties, commercial buildings, and real estate investment trusts, REITs. While real estate can be a lucrative investment, it also involves ongoing maintenance costs and the potential for market fluctuations. Understanding these investment types is crucial for building a diversified portfolio that aligns with your risk tolerance and financial goals. Diversification helps spread risk across different asset classes, reducing the impact of any single investment's poor performance on your overall portfolio. A well-diversified portfolio can provide a balance of growth and stability, helping you achieve your long-term financial objectives. Remember, there is no one-size-fits-all approach. Each investor's situation is unique, and it's important to consider your own financial goals, risk tolerance, and investment horizon when making decisions. Consulting with a financial advisor can provide personalized guidance and help you create a strategy tailored to your needs. By staying informed and making thoughtful choices, you can build a robust investment portfolio that supports your financial future. Risk tolerance refers to your ability to stomach fluctuations in the value of your investments. Are you comfortable with the possibility of your investments losing value in the short term for potentially higher returns in the long run? Or do you prefer more stable investments with lower but steadier returns? Your risk tolerance is influenced by factors like your age, financial situation, and investment goals. Younger investors with a longer time horizon might be more comfortable with higher risk investments, while older investors nearing retirement might prefer more conservative options. Determining your risk tolerance is crucial for making sound investment decisions. It's important to find a balance between risk and reward that aligns with your comfort level and financial objectives. Section 5, Goals, Charting Your Financial Course. Before you start investing, it's crucial to define your financial goals. What are you saving for? Is it a down payment on a house in 5 years, a comfortable retirement in 30 years, or your child's college education in 18 years? Your investment goals will determine your investment time horizon, which is the length of time you plan to invest your money. Short-term goals require more conservative investments, while long-term goals can accommodate a higher risk appetite. Clearly defined goals provide direction and motivation for your investment journey. They also help you stay focused and avoid making impulsive investment decisions. Section 6. Diversification and dollar cost averaging, your investment safety nets. Diversification is like not putting all your eggs in one basket. It involves spreading your investments across different asset classes such as stocks, bonds, and real estate. This way, you are not overly reliant on the performance of a single type of investment. By diversifying, you reduce the impact of any one investment performing poorly on your overall portfolio. For instance, if the stock market takes a downturn, your bonds or real estate investments might still perform well, balancing out potential losses. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This method is particularly useful in volatile markets. This approach helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your purchase price over time. It takes the guesswork out of trying to time the market, which can be a challenging and often futile endeavor. Diversification and dollar cost averaging are essential risk management tools for investors. They provide a structured approach to investing that can help mitigate risks and enhance returns over the long term. They help you navigate market volatility and build a more resilient portfolio over the long term. By consistently applying these strategies, you can create a financial safety net that supports your investment goals and provides peace of mind. Remember, the key to successful investing is not just about making high returns, but also about managing risks effectively. Diversification and dollar cost averaging are time-tested methods that can help you achieve a balanced and secure financial future. So, whether you are a seasoned investor or just starting, incorporating these strategies into your investment plan can make a significant difference. Stay informed, stay diversified, and keep investing regularly to build a robust financial foundation. Section 7. Taking the plunge, starting your investment journey. Starting your investment journey might seem daunting, but it's easier than you think. With the right approach and mindset, you can navigate the world of investing with confidence. Here are some steps to get you started on the right foot. 1. Educate yourself. Learn the basics of investing through books, online resources, or financial advisors. Understanding key concepts like stocks, bonds, mutual funds, and ETFs will give you a solid foundation. 2. Determine your risk tolerance and financial goals. This will guide your investment choices. Are you looking for long-term growth, or do you need short-term gains? Knowing your goals will help you choose the right investments. 3. Choose an investment platform. There are various online brokerages and robo-advisors available. Research and compare their fees, features, and user reviews to find the one that best suits your needs. 4. Start small and gradually increase your investments. You don't need a large sum to begin. Even small, consistent contributions can grow significantly over time thanks to the power of compounding. 5. Review your portfolio regularly and make adjustments as needed. Your financial situation and goals may change over time. Regular reviews will help you stay on track and make informed decisions. Remember, investing is a journey, not a race. Start small, stay consistent, and don't be afraid to seek professional guidance if needed. Patience and persistence are key. Over time, you'll gain more confidence and knowledge, making your investment journey a rewarding experience. Section 8, the long game: patience and learning in wealth building. Investing is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. Don't get discouraged by short-term market fluctuations. Instead, focus on your long-term goals and trust in the power of compounding. Continuously learning and adapting is crucial in the ever-evolving world of finance. Stay informed about market trends, research new investment opportunities, and don't hesitate to adjust your strategy as needed. Remember, investing is a journey of continuous learning and growth. By embracing patience, knowledge, and a long-term mindset, you can pave your way to financial freedom and achieve your financial aspirations.